Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
A reduction in our policy rate could be on the table as soon as the next meeting in September.
US futures point to further gains for the S&P after the Fed signals a rate cut as soon as the next meeting. Meta beats on sales as AI delivers Insta results, helping Mark Zuckerberg's company to sell more targeted ads. We look ahead to earnings from Apple and Amazon later today. Plus, oil extends gains on a New York Times report that Iran's supreme leader has ordered a direct strike on Israel in retaliation for killing Hamas's political chief in Tehran. We start on the earnings story and a very solid beat coming through from the French lender of Crédit Agricole, helped by its trading team. Second quarter net income for this French lender coming in at 1.83 billion euros, comfortably above the estimates of 1.64 billion. That is for Crédit Agricole, the investment bank outperforming at that French lender. Deal making coming back, and the business as well benefiting, delayed benefits coming through from the higher interest rate environment, of course, across Europe. So net income for the 3 months through June coming in at 1.8 billion euros. And that gain coming through for Crédit Agricole. The details around the expenses story, slightly higher than estimates, but net income again coming in with a decent beat. Second quarter revenue at 6.8 billion. The estimates had been for 6.48 billion in terms of second quarter revenue. It's a beat for Crédit Agricole. We're going to be speaking, by the way, exclusively with that French lender's deputy CEO, Jerome Powell, in our next hour. So don't miss that conversation. Staying in the world of finance, and we switch to what's happening with ING as well. We also have lines crossing from AB InBev. Before we get to ING, we have AB InBev, the brewer, of course, with a focus on the volumes out of the US story, but also China. So the lines coming through in terms of volumes for North America, contracting 3.2%, slightly less than had been expected. In terms of revenue in the second quarter for AB InBev, coming in below the estimates in the second quarter. Revenue increasing, organic revenue by 2.7%. The estimates have been for an increase of just shy of 4%. In terms of organic volume growth, you're seeing a contraction of 0.8%. That is a deeper contraction than the estimates of around 0.5%. So it's a miss in terms of the volume growth for AB InBev, and we know that North America is a key focus. Margins coming in at 34.6% in the second quarter, adjusted just slightly above the estimates. And in terms of underlying EPS, 90 cents versus the estimates of 86 cents. So on that sense, it's a bit of a beat. But the top line in terms of the organic volume growth, that is a miss coming through for AB InBev. Let's check in on the broader markets right now. It is the earnings story, it is the central banking action, and it is the Fed opening the door to that September cut that, of course, is in focus as we lead up to the BOE decision later today as well. European stocks then pointing currently higher in terms of the future story by just shy of 0.2%. FTSE 100 futures here in the UK pointing to gains of 21 points as we build up to that decision from the BOE, adding gains of 0.3%. S&P futures, after a solid session yesterday, closing higher by a little over 1% as tech turned around to the upside. S&P futures pointing higher by 0.5%. NASDAQ futures looking to build on the gains of yesterday, and what a rally we saw for the NASDAQ 100, a little over 3%. The likes of Nvidia soaring 13%. NASDAQ futures looking to build on that today, up 0.8%. Let's flip the board and look cross-asset. Treasuries giving up some, but not all of the gains of yesterday. We saw moves, of course, across the Treasury curve. Yields lower yesterday on the Fed story, pairing some of that today at 428 on the front end. The Japanese yen, what a story this has been in terms of the turnaround of the fortunes of this currency. 149 as Amundi and some others, including TD Securities, now eye 140 in terms of the strength coming through for the Japanese currency, and that's weighing on Japanese equities. The pound at 128 and Brent $81.50, up 0.8% on the geopolitical risks, of course, around Iran and Israel. To our top story of the morning, of course, in terms of the macro and Of course, central banking. Fed Chair Jerome Powell signaling the US is on course for an interest rate cut next month as long as progress on inflation continues. For more, we're joined by Bloomberg Markets Live reporter Mark Cranfield. Mark, your top take from what we heard. The statement and the language was adjusted at the margins, but it seems like we got a dovish line from Jay Powell in terms of the press conference. That appears to be the take from these markets.
Yeah, I think from a trader's point of view, the most interesting thing here is if you compare it to where we were in the first quarter, markets were pricing in something like 3 to 4 interest rate cuts. Here we are, third quarter of the year, we're still pricing in around 3 interest rate cuts. This time, Jerome Powell is not pushing back. He's more or less giving a green light. He's not 100% saying it's a done deal, but it's very much the door is wide open. And clearly, unless the data is very disappointing in the next couple of weeks, a Fed first cut of this series is going to happen in September. So unless the 2 CPI reports in between are very bad for some reason, it's a done deal pretty much. And probably for some more this year, at least one more, maybe even the 3 the market's looking for. So a completely different scenario. No pushback, and that's what the traders heard.
OK, the door wide open then for that September cut from the Fed, the first, of course, of the cycle. So the ECB has cut. They're looking maybe at another cut in September. The door wide open for the Fed in September. Surely the BOE goes today, Mark.
It's, as we've been reading, very, very close call. The decision may well come to 5 against 4 votes, either one in favour of a cut or one against not doing it now. More importantly, from an investor's point of view, is the guidance. What they want to hear is that the BOE, if they do cut today, has some clarity on where they're going to cut again. And that probably is not going to happen. So somebody's going to be disappointed today. People trading the pound will probably see it as a slightly bullish thing because they don't want too many rate cuts. But bond traders will probably be a bit disappointed. A lot has been priced into the UK gilt market, and it's unlikely the BOE will satisfy those expectations. Equity market can probably take it in its stride, providing that earnings around Europe and the US continue to be decent. But certainly a very mixed bag. Not everybody's going to be happy with the outcome today.
Mark Cranfield, thank you very much indeed. Wrapping what we've seen, of course, in terms of the Fed, what we heard from Jay Powell, and previewing, of course, that crucial decision around the BOE coming out later today, and we'll bring you full coverage of that, of course. Mark Cranfield from our M Live team, thank you very much indeed. Let's get back to the earnings story right now. Very pleased to say I'm joined for an exclusive interview with the CFO of ING, Tanate Phutrakul. And Tanate, just to wrap up some of the lines that crossed the earnings in terms of the net income coming in for your business. Second quarter, it's a beat for ING. You and the team coming in with 1.78 billion euros in the second quarter. The estimates had been for 1.66 billion. And here's the red head across the Bloomberg terminal then. ING total income outlook for 2024 increased to 22 billion euros. So Tanate, what gives you the confidence to upgrade the outlook for the year?
Yes, thank you very much, Tom. I think we come into this second quarter with good commercial momentum. We have added almost 248,000 new primary customers in the last 3 months. Our loan growth has been strong, particularly in the retail bank, with mortgage growing across all of our markets that we operate in. And that has been complemented by also good inflows of liabilities as our customer deposit more money with us, both in the retail as well as the wholesale bank. But the standout for us has to be strong fee momentum. We recorded almost €1 billion in fees, up 10% year on year. Our credit book remains strong, although risk costs have ticked up a bit. But I think at 1.8 billion euros, we come in with a strong commercial momentum and strong return on equity. And that's why we have updated our guidance on the back of that to be a little bit over the 22 billion mark in terms of revenue for the year.
OK, we know the fee story is really important for you, and you highlight that. That's one of the key standouts for you, as you say. And you and the team have set this target of 5 billion euros in terms of fees by 2027. How do you get to that target? How much progress have you made? Is that focused on organic growth, or do you need to make some acquisitions to get to 5 billion in terms of fees by 2027?
I think our strategy is based on organic growth. We have, as I mentioned, a key bellwether for us is continuing to add primary customer. And I think of the half year, we have added almost 500,000 new mobile primary customer. That's been a key for us. A key driver is also in terms of helping our customer to open more investment accounts with us And we have also seen good growth, almost 8% growth in new openings of investment accounts with us, on top of which we have been able to optimize our fee packages to our customer base as well. So these are all levels, our toolbox in terms of operating at a higher, structurally higher fee level than we have done in the past.
How do you see the loan volume growth evolving over the short to medium term, Tanate?
I think it's in two parts. In the retail bank, I do see loan growth being quite strong. As you mentioned at the top of your show, that interest rates are beginning to come down. Mortgage rates are normalizing. Housing prices are beginning to tick up in many markets, like in Belgium and in the Netherlands. And that is a conducive market for mortgage growth. Our growth actually has been a little bit on the high side because we've been gaining market share also in the second quarter. So that bodes well in terms of lending growth in the retail bank. The wholesale bank is more of a mixed picture. I think we see growth in certain areas, and where other areas we have been optimizing our capitals, been selling loans in some instances to make sure that we get the right return on equity. So it's a bit of a balanced picture, but overall, our target is to grow our loan book over the period by around 4% to 2027.
Around 4% by 2027. As we think about the interest rate environment then, Tanate, and you touched on this, markets expecting sub 3% by the start of 2025 in terms of the ECB's benchmark rate. What would that mean in terms of net interest income for the business and loan growth? How do you see that being balanced?
Yes, so I think there's probably two parts to that. I think as rates come down, then you would expect loan demands to increase, which means economic activities are getting more positive. So it should be positive for loan growth. In terms of interest margin, we do expect that interest margin on lending would be increasing because rates are lower, whereas we do expect liability margins to normalize more. But overall, we're confident to maintain a net interest margin over the cycle of around 150 basis points. This is what we have achieved historically, and we're confident we can achieve that in the future.
Should we expect that loan loss provisions will be edging up, will be moving higher, at least in the next couple of quarters, Tanate?
Yeah, we have seen that at ING, that our loan loss provision has increased from the last couple of quarters or so. We don't see it much in the retail bank. I mentioned mortgages, loan losses have been very small. We do see it a little bit more in the wholesale bank, but overall, if you look at our loan loss provision for the second quarter at 300 million, it's around 18 basis points over lending, which is below our through the cycle average. So we do expect normalization, but it's coming from a period of very low risk costs in the past couple of years or so.
OK, ING CFO Tanate Phutrakul joining us for that exclusive interview. Thank you very much indeed. With the upgrade, of course, in terms of the guidance coming through for ING on the back of some gains around the loan book and in terms of additional customers being added. Let's switch focus right now. We'll stay on the earnings story. We'll focus on supply chains. Really interesting in this environment of continued inflation, cost pressures, of course, and disruptions globally. In terms of DHL, of course, listed over in Germany, but with that global footprint, the lines crossing in terms of Deutsche Post DHL, in terms of second quarter revenue, the company coming through with 20.6 billion euros, just slightly above the estimates. So a beat in terms of second quarter revenue, just marginally. EBITDA coming in slightly higher as well, 1.35 billion in terms of the second quarter. So at this point, let's bring in the company's CEO, Tobias Meyer, joining me now from Bonn. Tobias, give me a sense then of how this quarter, how these numbers set you up for the quarters ahead. What is standing out to you in terms of what you're seeing across this business?
Yeah, good morning, Tom. So what we're seeing is a gradual progression in the economic cycle. We came obviously of a high during the corona pandemic. We saw then volumes softening, we saw rates softening, and this has now really bottomed out. But it's not really the same across the globe. We see pronounced differences in the different regions. So we see a good uptrend in Asia, exports very strong, not only out of China, but also other markets as well. Whereas Europe, for instance, continues to be relatively weak, especially also the trading within Europe. So it is progressing in the economic cycle, but not at the same pace.
How do you see volumes evolving then? I mean, you've obviously got the different units of this business, whether it's the e-commerce part, of course, the express part, the parcels part of the business. But overall, in terms of volumes, in the short to medium term, Tobias, how do you see that story evolving?
So on the one hand side, we have structural drivers, especially e-commerce, as you mentioned, people shipping more small packages to consumers especially. That structural trend is fully intact. We saw some dip after the pandemic where we had that huge boost, and that is now normalizing to the trajectory that we had before. On the other hand, there's the cyclical part, especially on the B2B side, in ocean freight, in air freight, in our express business. And there is the story that I just mentioned. Yes, we are progressing through the economic cycle. We have returned to growth in all of our 5 business divisions, but it is not the same across the globe. We see weakness in Europe. We see okay trading in the Americas, but we see really positive momentum in Asia, in the Middle East, and in Africa.
Where do you see those freight rates going then? You've seen the supply chain disruptions, of course, around the Red Sea. Freight rates are higher. To some extent, you've benefited from that. Are those higher rates sustainable, do you think?
Well, I think we need to clearly differentiate here between the different modes of transportation. On the ocean side, we have the ongoing disruption in the Red Sea, causing the diversion of ships around the Cape of Good Hope. That adds a lot of transit time, that ties up capacity, and this is why the capacity balance of demand and supply for ocean-going container vessels, that has tightened. That was not what we expected when we were a year ago in that situation where there is additional supply of tonnage through new vessels. So this situation is currently relatively tight, also because the exports out of Asia are so strong. So we have really seen a lot of liftings out of Asian ports. So that is one part where rates are clearly have risen to quite an astonishing level. Air freight is different. The B2B trading, tech still being relatively weak. But there we have a strong element in e-commerce out of China, which ties up a lot of capacity. It's often direct charter planes, so it's a business that we are engaged in, but not to that extent than in other parts. So that is something that ties up capacity on the Trans-Pacific route, for instance, and this is why the landscape is quite heterogeneous.
Okay, Tobias, Meyer, DHL CEO, thank you very much indeed for joining us. On the back of these results, it's a beat coming through for the second quarter in terms of the earnings from Deutsche Post. And we appreciate the time with the CEO, of course, looking ahead to how that story evolves and unfolds. Thank you, Tobias. Coming up, fears of a regional war mounting after Iran vows revenge on Israel. We'll get the latest from that region next. This is Bloomberg. Fears of escalation are mounting in the Middle East after Iran vowed revenge against Israel following airstrikes that killed senior Hamas and Hezbollah leaders. For more, let's bring in Bloomberg's Jemana Pasechi, who has the latest. Jemana, there are now reports coming from the New York Times and others that Iran's leader has actually issued an order for a direct strike on Israel. What do we know?
That's right, Tom. So we got a very strong wording out of these Iranian officials yesterday, with the supreme leader saying that he would like to seek revenge for the strike in the capital. In addition to that, overnight there was a report put out by the New York Times suggesting that the supreme leader himself has now ordered a direct attack to be administered in within Israel, saying that Iranian military commanders are preparing themselves for the possibility of a combined drone and rocket attack and specific targets in Tel Aviv and Haifa, but targeting specifically military infrastructure and not civilians. Now, all that is happening alongside the developments in Lebanon as well. Hezbollah yesterday putting out a statement actually confirming that the senior commander, Phutrakul, was killed in that airstrike that happened on Tuesday evening. 5 civilians as well were killed in the airstrike, 2 children and 3 women. But the leader of Hezbollah, the commander, Hassan Nasrallah, will be delivering a speech at 5 p.m. local time today, and that will be keenly watched for any clues on retaliation from the Lebanon border, alongside this New York Times reporting about what the Iranians may do as well.
Jemana, talk us through the oil market reaction to all of this.
Yeah, well, we have seen an uptick in oil. Yesterday, WTI was up more than 3%. Today, up more than 1.5%, as well as geopolitical premium starts getting priced into some of these energy markets. Bear in mind, today is also a technical meeting for OPEC+, the JMMC meeting. It's a market monitoring meeting, and typically they would just ascertain how the outlook is looking. Remember, the OPEC+ group are set to start withdrawing some of those restrictions at the end of Q3, so beginning to put back barrels to the market in Q4. But if this situation holds with the outlook from China demand still looking quite weak, it's unlikely that they will be incentivized to put further barrels back onto the market. And the reason we are seeing an uptick as of late is concern about geopolitical developments. That being said, none of the supply outlook has actually been hit. And as we were speaking about yesterday, Iranian supply has been on the up and up over the course of the last 5 years, pumping the most it has pumped in the last 6 years. Unless that oil infrastructure gets hit, it's unlikely you're going to see an impact on supply as well. Hence why the outlook from here seems to be quite balanced.
OK, Jemana Pasechi on the latest in terms of the tensions in the region and the impact, of course, on the oil markets. Thank you. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to other stories making the news this Thursday. SocGen posting trading revenue that helped the French bank outperform Wall Street peers, even as it continues to face disappointing performance at its domestic retail unit. Revenue from equities trading, a key unit, of course, for SocGen, surged 24% in the 3 months to June, beating estimates. Boeing's next CEO says there is much work to be done ahead for the plane maker. Kelly Ortberg is being hired out of retirement after rising through the ranks at aviation supplier Rockwell Collins. But the scale of the turnaround task he faces was immediately highlighted by a company warning that third quarter cash burn could reach $10 billion. Bill Ackman's Pershing Square has withdrawn an initial public offering for a US closed-end fund after sharply downsizing a $25 billion fundraising target and facing difficult questions from investors. Pershing Square says it will reevaluate its structure based on investor feedback. The withdrawal comes after the hedge fund manager slashed the anticipated size twice in just over a week. And Republican nominee Donald Trump has sought to question Vice President Kamala Harris's racial identity at a contentious roundtable with black journalists fumbling an attempt to reach out to voters of colour.
I've known her a long time indirectly, not directly very much, and she was always of Indian heritage, and she was only promoting Indian heritage. I didn't know she was black until a number of years ago when she happened to turn black, and now she wants to be known as black. So I don't know, is she Indian or is she black?
Well, Harris later condemned Trump's comments as being divisive and disrespectful. Coming up, Meta's AI investments might be starting to pay off. More on the company's upbeat earnings report next. We bring you the details. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
a reduction in our policy rate could be on the table as soon as the next meeting in September.
US futures point to further gains for the S&P after the Fed signals a rate cut as soon as the next meeting. On a knife edge, markets bet the Bank of England could vote for the first interest rate cut since the start of the pandemic. We are live on Threadneedle Street. Plus, Meta beats on sales as AI delivers instant results, helping Mark Zuckerberg's company to sell more targeted adverts. We're going to look ahead to earnings from Apple and Amazon later today. Before we get to tech, though, to the auto story of Europe and the focus, of course, on the German automakers, and it is a miss for BMW, and they can blame China for that. The second quarter auto earnings coming through in terms of BMW of around, in terms of the revenues, I should say, 32 billion. So the revenues in terms of the second quarter, marginally above the estimates, but in terms of the margin, that is the miss. The miss is in the margin for BMW, 8.4%. The estimates had been for 8.75% in terms of the earnings margin for this key German automaker. And we know that China has been a challenge. In terms of their full year margin guidance, we know that analysts have been watching for this. Would they adjust it lower? No, they are maintaining that margin range of between 8 to 10% for the full year. The second quarter earnings coming in terms of earnings before interest and tax, EBITDA at 3.88 billion. So let's round that up to 3.9 billion. The estimates have been for 3.93 billion. So in terms of earnings before interest and tax for the second quarter, that is a miss. In terms of margins for BMW for the second quarter, that is a miss as well. And the warning is coming through around that Chinese market. We know that consumers are reining back in terms of spend on big ticket items in that economy, of course, given the challenges around the real estate sector, and they have warned around the sales outlook for that market. Again, these are the lines around the margin squeeze and around the earnings before interest and tax. Volkswagen is also in focus for us as well. Returns falling on restructuring charges. We know that the EV segment around VW is in focus. In terms of the second quarter revenue for VW coming in above the estimates of 83 billion euros. Operating profit for the second quarter for VW is coming in slightly higher as well, 5.46 billion. The estimates have been for just shy of 5.2 billion. Let's get the take now from someone who follows this industry very closely indeed with that lens and with that scrutiny. Bloomberg's Oliver Crook standing by for us. Ollie, what stands out to you from these numbers?
Yeah, Tom, I mean, we saw from the sort of pre-release from both BMW and Volkswagen that this was not going to be a great quarter. We saw it, obviously, in the auto sector with all the other companies, with Ford losing a fifth of its value in one day, Stellantis, everybody really giving a lot of bad news for the auto industry. But for Volkswagen, you know, they've managed to maintain their guidance. I have to say there is some doubt within the analyst community about whether or not they're going to be able to deliver on that. I mean, when I'm drilling down into these numbers here in front of us, looking at the different sort of categories of vehicles that Volkswagen sells, because, of course, they've got their core group, which is sort of the mass volume vehicles, which has been challenged for a very long time, the progressive, the sort of Audis, and then the sort of luxury and sports. When you look at the margins across all of those divisions from a year ago versus now, it really tells you the story that you're seeing in the auto market right now. When you look at last year, the core brand was at 5.5%, 5.5. Now it's at 5. Progressive brand was at 10, now 6.4. Sports and luxury at 19, down to 16. This is really a question in the auto industry where you're seeing demand coming down. What does that mean for the automakers? That means that they're going to need to be able to preserve that margin, and the only way they can, they need to look at costs. And for Volkswagen, they've already said that they're going to have some additional costs this year, 2.6 billion euros, which is material. But also, Tom, something else that we should flag, and something we're going to talk to the CFO about later, Volkswagen is talking about closing its factory in Europe for the first time ever. So this tells you about it's a story about EV demand because it's an EV factory, but it tells you really how difficult this moment is for the auto industry.
One line on BMW that stands out to me is this. In China, in particular, and I'm quoting, revenues were impacted by heightened competition and weaker consumer sentiment. Weak consumer sentiment and heightened competition. Their deliveries in the Chinese market falling almost 5% in the second quarter. That is pretty substantial. China, competition, and, of course, the softness in the consumer, not to mention what's happening in terms of EVs, Ollie.
Absolutely. And Tom, you saw the same thing in Volkswagen. They don't break out the sales specifically because they have a lot of joint ventures in China, so it's not one for one. But you did see, basically, if you look at the sort of an aggregate, the VW sales in China were down double-digit percentage, right? And this is the story across the board. Volkswagen will go further and quote a little bit in terms of their outlook and what they see in China. They say that in China, the company expects the economic situation to begin to stabilize in Q3. Tom, there's a bit of a running joke, I think, with the auto sector in China, which is we're always expecting the recovery in the next half of the year, and that just hasn't happened really across the board. When you look at a little bit further into BMW, again, their margins coming under pressure. You mentioned EVs, Tom, and I think this is actually an important and an interesting point to make. When you look at the EV numbers for sales in terms of Mercedes and BMW and Mercedes and Volkswagen, they were down in the first half of the year. The only German car company that really has a positive story to tell in terms of the EVs is actually BMW, while Mercedes in the front half of the year, their EV sales were down 23%, almost a quarter. BMW, that same period of time, up 22%. So for them, in terms of the sales revenues, in terms of really being a driver, EVs are actually a bright spot for BMW in a moment where that's maybe not the case across the rest of the market.
That's why we get Ollie Crook to cover the autos earnings for us, because you bring out that distinction, Ollie, that divergent picture in terms of the EV story, because it's easy to do a broad brush look, isn't it, and say EV sales growth is falling. But there you point to that important divergence between BMW and VW. Really, really crucial. Ollie Crook, thank you very much indeed, breaking down the numbers from VW and BMW. We appreciate it. We're going to be speaking, by the way, with Volkswagen CFO Arno Antlitz, following, of course, their earnings. Don't miss that conversation later today, 8 a.m. UK time. Right, let's check in on how the Asian markets are faring. Avril Hong is standing by in Singapore. Toyota is part of the mix there, and the Japanese equity story as well. Fascinating on yen strength. Avril.
Absolutely, Tom. I mean, we are keeping a close watch on these auto stocks, this part of the world as well. Toyota showed that climb in profit 17% from a year ago thanks to the weak yen, strong U.S. sales. But operating income was a miss, and similar to its European counterparts, China is a pain point. But also, what you see on the stock today is really interesting. This decline is the biggest since 2016. Helped along by, or not helped along, I should say, by the strengthening in the Japanese currency. Given how the BOJ, sounding hawkish, is meeting a dovish Federal Reserve, the yen is at the strongest level since March against the greenback. Let's flip the board and take a closer look at what we're seeing in Japanese equities, because that hawkishness from Ueda a day ago is certainly something that markets were not prepared for. The topic seeing its biggest decline since the early days of the pandemic. All sectors are down, and that is despite what we're seeing in some of the other major indices, this green coming through thanks to what we heard from Powell. Tom.
Avril Hong in Singapore with the Asian market check, and it is a pretty fascinating day in terms of how these Asian markets are reacting to yen strength and, of course, what we've been hearing from Jay Powell with the Toyota focus as well in terms of the earnings story on that automaker. Thank you very much indeed. Let's check in on these markets then, and we saw some significant moves, particularly around technology yesterday. The Nasdaq 100 posting gains of around 3%, the S&P ending higher by 1.6%. Today the handoff then via Asia to Europe, and the futures are pointing higher by 0.3% on European futures. FTSE 100 futures will build up to that decision from the BOE. We're traded expecting the first cut of the cycle, and FTSE 100 futures pointing to gains of 0.3%. S&P futures looking to add to the upside of yesterday, up 0.6%. NASDAQ futures pointing higher by 0.8 again after that rally. Nvidia was up 13%. Nvidia added $330 billion in market value in a single session. Let's flip the board and look cross-asset then, because there had been moves into treasuries on the back of the signalling by Jay Powell that September is very much in play in terms of the first cut, and treasuries will bid. Unwinding a bit of that today at the front end, 428 on the 2-year, yields up just 2 basis points. Japanese yen strength, there we go, 149 as some, like Amundi, point to 140 as potentially the next level to watch for the Japanese currency. 128 for the pounds, we watch around the BOE, $81.48 right now on Brent, around the Middle East tensions, up 0.8%. Let's get more details then on the tech earnings story, with the details and the focus on Meta overnight. Shares jumping then after reporting better than expected sales and displaying evidence that AI is helping sell more targeted ads. The CEO of the company, of course, Mark Zuckerberg, spoke on the earnings call.
There are all the jokes about how all the tech CEOs get on these earnings calls and just talk about AI the whole time. It's because it's actually super exciting, and it's going to change all these different things over multiple time horizons.
At this point, let's bring in Matt Bloxham, tech analyst at Bloomberg Intelligence. So the ads business being powered, to some extent at least, by some of the integration of AI. Talk to us about what we've seen and how that sets the business up going forward.
Yeah, that's right. I mean, revenues were about 2% better than people expected. So lots of positive commentary about how AI is kind of affecting the business. I think you also have to put in the context that through this year, all of the big media investment companies, the ad agencies own, have been upgrading their full-year advertising forecast. So the ad market generally is doing better than expected because of elections, Olympics, all these kind of things, just generally brands spending more. So the overall ads market is probably going to grow about 8% this year. Previously, people think it's going to be about 5% growth. So it's a stronger than expected market. So it's not surprising that Meta, given that pretty much all of its revenue comes from ads, is benefiting from that because most of that investment goes into digital platforms. And they are doing lots of things, including AI, to make their platform better. They've also done a lot of work on Instagram, on WhatsApp integration and Reels, all these kind of things, which is kind of really helping. And we saw about a 10% year-on-year improvement in revenue per ad. So they're getting kind of much better quality impressions from the business. I'd say CapEx, they're spending a huge amount of money on AI investments, but the good news yesterday was that although they kind of nudged up the lower end of their CapEx range, the top end didn't move. So, they're kind of maintaining those investments within that envelope, but they did point to a further big amount of investment next year to support AI.
So the CapEx spending continues for Meta in terms of the spending around that AI infrastructure, and that ties us to, or takes us to, some of the chip makers, not necessarily directly linked to that, but we had ARM, which is certainly part of the AI play, and also Qualcomm as well, smartphones and mobiles. Are they two distinct stories, or is there a merge there? What did you see from those two companies?
A bit of a difference. I mean, both of them are a bit more muted, so, not really seeing any improvement in the revenue outlook. Still pretty good momentum, but I think there's certainly some softness with Qualcomm around the broader smartphone market. High-end smartphones are doing well, and that's a kind of overlap with ARM. ARM saw some strength in high-end smartphones, but the broader smartphone market isn't recovering in the way they kind of expected to. So, that's kind of keeping their expectations for kind of forward growth tempered. And interesting on your kind of EV segment you just talked about, certainly for ARM, they're seeing some softness in some of those auto segments too, and that does relate directly to EVs because, EVs have so many chips in them, and if you're not selling enough EVs, then that's going to affect the kind of licensing revenue that you're going to get for someone like ARM.
OK, that's really interesting to link what's happening in terms of the softness around EVs to ARM's fortunes as well. Matt Bloxham with a deep dive in terms of what we'll be seeing within the tech space from Bloomberg Intelligence. Matt, thank you. We're going to be speaking, by the way, with the CEO of ARM, Rene Haas. That's coming up 4 p.m. London time. Coming up on a knife edge, will the UK's central bank vote for the first interest rate cut since the pandemic? We're going to get the latest on that big central bank decision in focus today. Stay with us. This is Bloomberg. Welcome back. Now, markets are pricing a more than 50% chance the Bank of England will vote for the first interest rate cut since the start of the pandemic. Today, our UK correspondent Lizzie Burden joins us from outside the BOE for a preview of that decision then. Talk to us about whether or not there is a lot of uncertainty around this decision, Lizzie. It seems like it's fairly finely balanced. The traders have their view, the economists have their view. What do we know leading up to this decision by the BOE?
Very finely balanced indeed, Tom. Market pricing actually has been creeping towards the 60% level over the past few days on thin air, really. No speeches, no news to base that on. But even economists reckon that the vote split today could be a 5-4 split, so really a tight decision. Now, the reason that traders are so in the dark today is, first of all, because we haven't heard from the Governor Andrew Bailey since May, because, of course, that snap election was called. You've also got an unknown entity on the committee in the form of the new Deputy Governor, Claire Lombardelli. We don't know how she's going to vote. And on top of that, most importantly, the data have been mixed. Yes, you've got headline inflation back at the 2% 3% target. But beneath that, services inflation came in hotter than expected, although if you strip out the volatility, you could say it's coming down. And on top of that, since the start of the year, growth has been rebounding more strongly than anticipated. So it's a difficult picture. But the point is, if they don't cut today, when you've got the opportunity to explain it through the press conference and the updated forecasts, they could miss the window if inflation rebounds before the end of the year.
And you touched on politics, Lizzie. How does the decision today tie in, if it does, to UK politics?
Well, of course, you've had lots of Conservatives tearing their hair out at Rishi Sunak for calling that election and handing Keir Starmer the first rate cut. We'll see if he gets it today. But on top of that, we've got the updated forecasts coming. Now, they could be potentially pretty awkward for the new Prime Minister, Keir Starmer. He's targeting 2.5% growth, but actually the BOE could see long-term growth potential in the UK actually below 2%, which would create more of a fiscal headache for the Chancellor Rachel Reeves when it comes to deciding between tax rises and spending cuts. We heard a bit about that at the start of the week. Finally, we could get an update on asset sales. Not actually expected till September, but economists increasingly saying we could get one today, and instead of slowing down the pace of asset sales, they could maintain it at £100 billion a year or even accelerate it, which really would add to the fiscal nightmare for Rachel Reeves, because of course the Treasury covers the losses, and therefore she'd be choosing even more between tax rises and spending cuts on that October 30th budget.
OK, Lizzie Burden outside the Bank of England, tying in the politics and the ramifications for this new Labour government, of course, with that decision when it comes later today from the BOE. And, of course, Lizzie will be covering all of that for us throughout the day. Staying with this topic, let's bring in Chatham Financial Managing Partner and Head of EMEA, then, Jackie Bowie, for another take on what to expect from this BOE. Jackie, good morning. Thank you for joining us. Do they go with the cuts?
Well, it certainly feels like the market is pricing that. But interestingly, there's still, a 40% chance based on other market indicators that they stick with a hold. And I think what we're seeing through the inflation data is that there are not clear signals that inflation has been beaten. So I think everyone's using the knife edge. It really is the most balanced and finally balanced decision the Bank of England's probably had this year. Looking out to September, of course, there's still a 90% priced in that they will definitely cut in September. So it really feels that they could surprise the majority and stick with interest rates at 5.25 and following the lead we got from the Fed last night.
And we're going to get an update, of course, on forecasts. We're going to get a lot of data from this Bank of England after this decision as well. On the inflation part of that story, Jackie, what are the risks in terms of the upside risks to inflation? What would get inflation to come back again? I mean, we've made progress. We're at 2% on the headline basis. I know we lift the lid and it's a bit more complicated. But surely the risks around higher inflation have abated, have they not?
Well, it's that services inflation that are really causing concern for the Bank of England. I mean, at 5.7%, that's, way above where they would really need it to be to justify an interest rate cut. And whilst we haven't seen the impact of some of the statements the new government has made around public sector wage increases, they're indicating that they are likely to be pretty substantial. Now, the Bank of England will say they can't take into account government statements. It isn't until it actually hits policy that you'll then see an inflation. But there's certainly a lot of concerns in the market that what the government are saying from a fiscal perspective could actually be negative for inflation and then justify interest rates staying on hold.
Jackie, if they go today or if they hold until September, post that decision, how do they sequence cuts going forward?
Yeah, I mean, it still looks like by the time we get to the end of this year, UK interest rates would be about 4.75. So that would be 2 25 basis point cuts. So one in September and then one more before the end of the year. So that still seems the most kind of likely scenario. But I would say that we've got a big inflation number coming on the 16th of August. So going back to what I said at the beginning, we're absolutely not out of the woods yet. Think where we were at the end of last year with regard to interest rate cut forecasts for, the UK and the US, and none of that has been delivered, and we're more than halfway through the year. So there's still definitely room for that inflation data to surprise and for interest rate cuts not to come through as the market is predicting.
OK, interesting. With those assumptions, and briefly, Jackie, where do you see growth in the UK by the end of the year?
Yeah, we're going to get the new numbers from the Bank of England today, and we've already seen some economists come out and, bump their numbers up a little bit. I don't think it's going to be great. I still think we'll be seeing pretty weak growth around the kind of 1% level. But the good news is it's moving in the right direction, and it's actually, we're doing a lot better than some of the other European countries. So I think you might find a little glimmer of good news, but the absolute number is still not going to show amazing growth numbers for the UK.
OK, managing partner and head of EMEA at Chatham Financial with a take as we lead up to that decision from the BOE. Jackie Bowie, thank you very much indeed. We're going to bring you, of course, that policy decision, and for our viewers here in the UK, special coverage of the press conference, 12:30 p.m. UK time. Do not miss our interview with the Bank of England Governor Andrew Bailey. That's at 5 p.m. UK time today. This is Bloomberg.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. We have made no decisions about future meetings, and that includes the September meeting. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Fed Chair Jerome Powell, of course, speaking there, handing the baton now to Andrew Bailey and the BOE, making that decision later today. Markets pricing in, by the way, 51 basis points. The market's expecting the rates go from 5.25 in the UK to 4.75 by the end of this year. If they cut today, listen out for any forward guidance in terms of the sequencing going forward. And by the way, that if is doing a lot of heavy lifting, because we know that this is a decision that is finely balanced from this UK central bank. That is the context in terms of the market pricing and whether or not we'll get any guidance in terms of the language. We'll also get the forecast as well in terms of the data update from the BOE. Let's flip the board and have a look at how the central bank story and lower rates, or at least expectations of lower rates, is tying into the tech story, because, my goodness, Nvidia has been volatile. We're not talking about Bitcoin here. We're talking about Nvidia. The moves, substantial, gaining more than $300 billion in terms of market cap just in a single day. That was one day after the stock fell 7% and dropped about $200 billion. This is more volatile, Nvidia, right now than Bitcoin. Now, there's plenty more coming up. It is a massive day for central banks, but earnings as well. Credit Agricole, Shell, the London Stock Exchange Group and Haleon all have earnings today. We speak to the CEOs and executives of those companies. This is Bloomberg.